We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Michael Oliver from Momentum Structural Analysis. Thanks for joining me today, Michael.
Hi, Tom. Good to be back.
Excellent to have you back. So as you analyze many markets and sectors, obviously for our audience, the metals are the most important, as movement in the metals will be followed by movement in the miners as well for the most part. So why don't we start with gold? Are we seeing sufficient indicators here that the upturn out of the protracted correction mode by gold is ending?
Yes, I think so. What's happened last week was, I think, moving to the starting gate. And right now we're at the starting gate. Now, when you let's play games with the price chart now. If you look at a price chart of gold, you'll see we made our high above 2,000 briefly last summer, had a drop, but there were two highs since then that were prominent, and they were both at 1,900 area. One was in January, had a drop into March, came back up in May, again 1,900 area. So if you're looking at a price chart, you're saying, well, where do I get bullish on gold again? Or, if I sold my position, where do I get back in? You see this 1900 shelf. And it looks like if you can clear that, you're on your way up again. And, that's what the price chart says. Mm-hmm. And when you look at a silver chart, it got up near 30 last summer, dropped down to about just below 22 in September of last year, and then went into a range between 30 area at highs. And by the way, if you look at weekly silver, you'll see that there was a cluster of three peaks that all had weekly closes around 28. So the intra week, you got up to 33 times almost. But on the weekly closing basis, you've got three peaks around 28. So if you're looking to get into silver or reestablish your silver position, which you dumped or whatever, it looks like 28 area before you get excited again. Okay, that's what price says. So it's similar to gold. You're not there right now, right? Okay, silver's under 25, gold's at 1828. Our momentum work, when we analyze price and its relationship to certain long-term means, moving averages, and I don't mean overlaying some silly moving average on a price chart, but oscillating it on a momentum chart, shows major structure, just like those price charts do up there, except we're at the structure now. In the case of gold, 1825 is one of our magic numbers. You close a week out there. This is only Monday, okay? You close a week at 1825 or higher anytime during this quarter. As far as we're concerned, that's thumbs up. You're coming out of the starting gate, gold's beginning again, okay? Silver's number is 2.5% or so above today's high in the low 25s, which when you look at a price chart, doesn't make, it was 25. It's sort of in the middle of the range of the last 16 months now. But when you look at our momentum charts, it says, no, you're about to launch again. So both silver and gold have moved up to levels that, based on our long-term momentum work, say, okay, you're at the point now where they're going to flip the switch green again and probably jolt these markets up out of this congestion zone.
So as you're talking about that 25 or so dollar level for silver, is that on a weekly close that you need?
Yeah, we'd like to see a weekly close. I'll give you an exact number. 25, 37 or higher. Okay. There's actually some other indicators that's based on 3/4 moving average. Okay. Now, most people don't use that kind of average. It only changes once every quarter. You average the prior 3 quarters, you get a new number. Most people look at 200-day averages. And 200 days, if you think about it, that's about 3/4 of a year. Okay. Now, on a 200-day average momentum chart, it's going to engage a bit before that. And I don't mean just getting above the average itself. That's not all that important. So there's a bunch of long-term metrics that we're challenging, and many of them we've already crossed. But we're looking at our 3/4 average oscillators of gold and silver, and they're going to be the last ones to engage. But they're still going to engage well before you ever get up to price levels that the public's going to say, "Oh, breakout." And we're basically there. We're basically chewing it at the starting gate. And I think we're going to go through. There's other factors out there that make sense to us that would indicate that. And I chuckled this morning looking at the Wall Street Journal. We've been arguing for quite some time that Treasury bonds, that's a 30-year US government bond, futures, which is fairly illiquid compared to a lot of other government debt instruments, 10-year and so forth. But it's the least under the control of the Fed of any of the debt instruments. Okay, it's very long term. That it's behaving like gold. If you'll go back and look to last summer when gold made its high weekly close, that was in the first week of August. Well, T-bonds made their high weekly close, T-bond futures, in the last week of July, 1 week apart.
Interesting.
Both of them subsequently dropped in layers. Mm-hmm. And when did they make their low? March. Gold made its lows in March this year. T-bonds made their low in March of this year. Both of them rallied. Both of them then tried to pull back recently. Now, both of them have engaged on the upside. T-bonds have broke out last week, as far as we're concerned, in terms of their quarterly momentum. Now, why is that? You know, why would T-bonds be dropping in yields, rising in price? If one, the Fed taper talk is for real, or is it going to tighten in some respect, way, or form over the next year or so? Mm-hmm. Why would yields be dropping? And two, stock market's behaving well, so why would T-bonds be a flight to quality, you know, as they have been before? Why would people be buying T-bonds when the stock market's behaving well? And why also would T-bond yields be dropping if we have inflation again? It makes no sense at all, right? Well, technically, it makes a lot of sense because I think what's really going on there is to somewhat what's going on in gold, and that is major asset managers, hedge fund managers, mutual fund managers who've been around a while, have some experience and haven't forgotten the last 10, 20 years, you know, gotten all gleeful because of the stock market. They're somewhat suspicious of what they see in the stock market. There's all kinds of valuations that just don't make sense. The longevity of the market doesn't make sense. The steepness, the recent steepness, especially since last summer, scares them because it's blow-off type action, and blow-offs end very badly the other way. So I think there's some smart money out there that's saying, hey, you know, I'm not going to get out of the stock market, but I'm going to shift some money out. 5% here, 5% there. And I think what they're doing is it's moving into those asset categories, safety of T-bonds and gold and silver. I think that's why those two markets are moving in sync right now. Don't expect it to continue. Because ultimately, yes, the T-bonds will go down in price, up in yields, because if inflation persists, which we think it will, then you will suffer if you're long the T-bonds. But right now, everybody got short. And the front page of the Journal today explained how so many fund managers and other institutions who've been short T-bonds, looking for higher rates, got killed recently. And I think it's only just begun.
So when we analyze, you know, markets like, let's say, the S&P 500 or the NASDAQ 100, how extended are both of these charts above their momentum monthly ranges? And would the momentum analysis start to identify a topping pattern or reversal here?
I frankly think we're topping right now. And I have been thinking that we're in a topping process for several months now. That doesn't mean it can't go up. I mean, you're up until you're down, right? You know, Joe Granville said that. But we have numbers below the markets, both on the NASDAQ 100, which is our leader index. There's no question it's been the leader. It's outperformed everything. You know, the top 5-6 stocks in the NASDAQ 100 constitute over 50% of its weighting. We all know those symbols: Amazon, Apple, Microsoft, Google, et cetera. They also constitute probably about 25% of the weighting of the S&P 500. So as these indexes have moved up, it's not because of the, you know, all the symbols within the index. It's primarily because of the leadership has been so strong. And therefore, focus on the NASDAQ 100 because that's where the leadership is really weighted. We see numbers below the S&P and below the NASDAQ 100 that aren't that far down there. In fact, I just throw out some numbers for you. Around 4,400 S&P, you don't want to see it ever again. And these numbers adjust upward each month, by the way. And on the NASDAQ 100, which is 16,000 plus, you don't want to get back much into the high 14,000s ever again. If you do, we're going to trigger some annual momentum structural breakage points, which we measure not on a price chart, but on annual momentum charts. And by that, I mean when we measure those two indices in relation to a 36-month average. That's not where those averages are, but that's where the structure is on the momentum charts. So what we're saying is the market can't afford even a 5% drop and certainly nothing approaching 7, 8, 9%. You're going to start to blow these structures. And when you do, we're going to declare top is in, it's over. Then you get what you get. Now, considering that we've had a dozen-year uptrend, which is highly unusual, and a lot of that's been vertical, especially the last 12, 13, 14 months of it, since last summer anyway. It's scary. And it's scary because if you're a price guy and you're looking at, let's say, a weekly or a monthly price chart of the S&P or the NASDAQ 100, and you look at your screen, try to define where you think it breaks. Try to draw a trend line. It's almost impossible. Whereas you might draw one and then it goes up at a steeper angle. We have to draw it again at a steeper angle. It's like multiple lines. So there's no line that touches 3 points. It's just a curve. The problem for the price chart technician at this point in time is when you turn down, there's no consensus as to where, oops, it broke something. And when you don't have a sense of, where you are on the map, emotions can take over. Panic can ensue. So it's going to be an interesting game this year. And I think 2022 is going to basically resolve it all. And there's a lot of stuff's going to happen this year. Not just the beginning of stuff, but actually the culmination of many of these turns.
So, Michael, when we think about breaking some of these momentum structures, what role do you think the algorithms play in triggering some of those levels? Getting that price sold off. Do you think that they play a more volatile role on the way down as well?
It could be. I don't. We try to put blinders on. MSA does, momentum structural analysis. We don't. I mentioned that I saw the front page of the journal today, but I don't try to pay attention to what other people think or what other factors might be in play here. There are major factors in play, big fundamentals in play. We all know that. In our last weekend report, we had a Fed funds rate chart going back like 30 years. I mean, you just look at the silly thing and you say, no wonder the stock market's gone vertical for a dozen years. I mean, the Fed funds rate's like at the bottom of the page and it's not even hiccuping. It's at zero. And we hiccuped a little bit and back to zero. And for 10, 12 years, no wonder the stock market was inflated. We've had inflation for many years. It just didn't go into commodities until beginning October or so of last year, when asset managers again did what? Change their preferences from stocks to undervalued commodities that have less risk, probably more reward. And sure enough, that's what's happening. So now we have what the public and the Fed call inflation. In fact, we've had it all along. It's just been expressed elsewhere in a vertical stock market. So I think that bubble's going to burst. Not that the flow of money from the Fed or the ECB or the BOJ is going to stop or taper. It's just going to go elsewhere because people aren't going to put it where the Fed would like them to put it. And there's some other vulnerable areas out there that you've got to watch as well. When you don't just look out your window, your windshield, look out your left and right mirror. I'd look at high yield corporate debt, such ETFs as HYG, JNK, junk, and also look at muni bonds. Those are two asset categories that aren't behaving like T-bonds. Whereas over the last couple of months, while the stock market's gone up, and they generally have moved with the stock market up, the Fed bought them, in fact, last year. Bought those two asset categories outright. They've gone down for the last few months. Well, the S&P's continued up, so they've divorced from the S&P. Now, who's right? Is the weakening muni bond market and the high yield corporate debt market, and they're just above levels that we think if they break them, they're headed down. They haven't broken the levels yet. We're very number specific in our reports. We've got numbers just below the feet of these markets. But if you break those two markets, we suspect the S&P is going with them. Now, what's the central bank going to do when the debt markets they must defend are breaking down? Are they going to taper? They're going to raise rates? I think not. And I think gold knows this. Basically the central banks of the West are caught in a historical dilemma of their own creation. And they're going down the swirly along with their policies. And I think they're going down the swirly this year.
So it's interesting that you brought the Fed funds rate chart up, and that was actually where I wanted to go. Like, what do you think the possibility of the Fed actually raising rates is? Will they be forced into trying to raise rates for optics maybe, and be forced to back off after that?
Well, again, who's going to be head of the Fed? We're going to know probably in the next week or two, because I suspect it may not be Powell. Though really, I don't think it matters, frankly, whether he stays or Lael Brainerd takes over, although we know she'll be more accommodative. Biden doesn't need a weak stock market. He's had too many things go against him. He needs the Fed to defend that category, okay? And I'm sure she will. Just like Lagarde in Europe at the ECB, she's not flinching, okay? But I think that they will continue their policy, because if these other asset categories, again, we're looking at our side mirror, muni bonds, junk corporate debt, high yield corporate debt, if those start to fracture, and if the S&P even wobbles 5% off its high, and the sense of doubt rises among the public and asset managers as well, then the central bank has no choice. They can either implode those structures by raising rates, or they can come to their defense. They have no other alternatives. And I suspect their answer will come to their defense. And then, of course, what do you have? You have monetary excess beyond anything you've ever imagined. And ultimately, that won't last either. Why? Because it's not feasible. You end up with a swirling.
A swirly into inflationary
and maybe deflationary in certain asset categories as well at the same time, where value destruction and value goes. Where will money want to go? As it's been said, cash is trash, right? Okay. Major asset fund manager said that some months ago, and he's dead right. And he's not even the gold bug. Okay. So I think the public is getting aware of this. And then we come to another interesting issue that's been debated on a lot of the financial channels lately. In fact, I saw something today on it. Bitcoin or gold? Well, we measure them both. In fact, we have a special report on Bitcoin that comes out every 2 weeks only. But we've been watching the spread relationship between the cryptos, especially Bitcoin and gold, and Bitcoin and silver. Because our bet's on silver. We think silver is going to vastly outperform gold. Mm-hmm. Silver's going to leave gold behind on a percentage basis. But that spread is measurable, meaning the spread relationship, the valuation of Bitcoin versus silver. Well, clearly over the last, since Bitcoin's been around, it's a baby. It's only been around half dozen years or more. It's thrashing. People can't quite put a valuation on it, but it has definitely beat gold and silver in an irregular manner, but in an upside manner. Very violent, just like its price has been. Those charts to us look vulnerable. In other words, it looks like we could be nearing a point where Bitcoin, on a valuation basis, relative basis, could top out versus gold and silver, and that they could replace it as the place where people are putting their money for safety reasons. And it wouldn't surprise us. In fact, I think maybe in the next month or two, we'll have enough evidence to make a statement to the effect that, okay, the shift has occurred. It's time now to shift out of Bitcoin and into gold and or silver, preferably silver. Now, that doesn't mean Bitcoin's got to go down. It just means that Bitcoin will shift relative performance such that silver will beat it going forward. And I think that's about to happen. We'll see some evidence in the next month or two, I think.
So I'd like to go back to, talking about the hyperinflationary point that we were making, Michael. Before we get to that point, are we headed maybe more for like a stagflationary type of environment, like the 1970s?
Like the late 70s, except more exaggerated. Mm-hmm. And ultimately, this time, I don't think there's a way out. And by that, I mean, you're not going to end with policy working, or a Volcker comes in and ends it, and just puts the brakes on and stops the process. Of course, then you went down. We all know that once that happened. The stock market was a wasteland from about 1977 through 1982 at least, while gold and commodities outperformed it. But this time, I think it's more, pardon me for being melodramatic, I think it's more final. Mm-hmm. Meaning, I think at the end of this next crisis, and I think we're headed for one, not just in pricing, but in social impact, that you're going to have people raise the question, it's been 50 years of this stuff since that Republican Nixon took us off the gold standard, international exchange basis of the dollar. And we've had nothing but fiat currencies in Europe, here, and Japan since then. It's been, playing games with deuces wild. Okay. It hasn't worked. It just takes an admission on the part of some academicians, some people in business and so forth. This hasn't worked. And we think we've been under control, had a policy and all this nonsense. And it's just been a boom bust cycle, getting worse and worse each time. And when that recognition occurs, I think it's like tabula rasa. It's all clear the decks, we start over and we figure out a new way. And it wouldn't shock me, what a world this is to say this, that the ex-communist countries of the world have gold-backed currencies before we do, and set the new trend. And I think that's likely to happen, where we end up with stable currencies. It could be crypto. Crypto at least can't be hyperinflated. It can be expanded somewhat year to year as they find more, et cetera. But it can't be, double the money supply every year like the central banks can do. So it's going to be an interesting year. And I think the markets are going to create what I call a swirly. And that swirly will affect not just markets, but people.
Well, of course, as you're saying, those ex-communist countries could lead that possible gold-backed fiat currency or currency replacement.
Yes.
Obviously, we've seen China stacking gold, Russia buying lots of gold, and it's exactly as you say. It's going to be really interesting to see what the outcomes and that leadership in the world, how that culminates, right?
Yeah, it's hard to predict these things, but I think the trend is pretty evident, and we know that the wave effects will create all kinds of unusual outcomes that a lot of people can't. It's not on the tip of their tongue right now. Mm-hmm. Political events, social events, and so forth that are perceived to be traumatic, but actually will be healing. Mm-hmm. Because if you get rid of something bad and it makes some noise while you're getting rid of it, that's the way it works sometimes.
Right. So as you're talking about these secondary effects, Michael, when we look at the commodity complex as a whole and really take into consideration the secondary effects of rising prices like natural gas, for example, could another downstream effect of that having a real shortfall in available fertilizer supply for next year also become an issue?
Yeah, it's not everybody knows, but the natural gas is key factor in making fertilizer. Mm-hmm. You have a natural gas shortage, or if natural gas prices are through the roof, it's hard for the fertilizer companies to make profit and manufacture the fertilizer. So CF Industries, as I understand, which is a stock pick we picked last year along with Mosaic, two fertilizer companies that have no correlation to the stock market over history. In other words, while the stock market's going up from 2011 to the present, there was some turbulence in 2011, if you recall. Commodity prices have been going down. Had been going down through 2020. So did the fertilizer companies. And they've since exploded. Well, CF Industries in the UK shut down apparently some factories or all, I'm not sure of the story, but curtailed production because of the high cost of natural gas. We were making money. And the UK government came in and I helped them reopen some kind of subsidy or something. I'm not sure of the details. But that's how bad it could get. So the natural gas phenomenon, which is our favorite pick right now among commodities, excluding gold and silver now. They're in a separate category. They're monetary metals. They're not just raw commodities. But among the raw commodities, we like natural gas the most. And we got bullish at $2 and then above $4. Right now, it's either side of $6. We think this surge could at least go to $9. And if you go back and look at natural gas prices in the U.S., $9 isn't even high. Mm-hmm. We've been up in the teens back in the 15, 20 years ago. So, but that could have an amazing effect on the average person's home costs, home heating costs, mm-hmm. industrial production of anything, because it affects power costs, production of fertilizer, both the cost of the fertilizer and the availability of it next spring. So that's all. That's the next domino. In other words, if natural gas takes off, because it's like triple the price in Europe that it is here, and if we have another leg up, what are the fertilizer companies going to look like and do in terms of the output? Will that affect the grains next year?
I was going to say that obviously the downstream, effect of that would be food prices going up higher and or not being able to meet their quotas as well, right?
Yeah. Well, we had one commodity that we've been watching for a good while. Grains turned up late last year. We got bullish on beans at just above $9, and corn and wheat turned up, and they've had big moves and now pullbacks. Pullbacks we think are a buying opportunity. Mm-hmm. But cattle was very interesting. Cattle only had a nice move up, but it stopped at what we call annual momentum resistance, something we could define. It went back like 10 years. It was a momentum trend channel that it was bumping the top of repeatedly for the last 6 months, closed last month above it. So we had live cattle. Now beef prices are now going to take a leg up. Now, that hurts the average family. And this is a breakout that just occurred. So it's not like it's been going on for a year. It just broke through this major threshold, and we think there's a lot more to go. And, I think corn is a big issue for feed prices for animals. So what happens to corn plantings next year, acreage, yield, et cetera, will affect meat prices. Dominoes hitting dominoes.
Exactly. So if natural gas and let's say crude oil keep rising, could that also trigger a recession?
Well, you'll have, I think you'll have recessionary effects, but still with rising prices. So you'll have what you call stagflation. Extreme one way and extreme another. It doesn't make sense to a lot of orthodox economists, mm-hmm. but that shocked them back in the late 70s. They had to invent a new word. Stagflation. They didn't think it could happen.
Right.
Well, now they know it can happen, but they've forgotten about it. So I think it's going to happen again, yes. And you'll see slowdown effects in certain parts of the world economies and people's lives. Whereas you're going to see rising prices, and that's not because things are good.
Right.
No.
So, Michael, when we think about analyzing charts with different moving averages, and we take, let's say, the quarterly 100 and 200-day moving averages into account, when these start to add up from shorter time frames to longer, does this strengthen the move when we see a breakout on each one consecutively?
That's what we do in our reports. We tend to not focus too much on short term. I know a lot of people like to be traders. Mm-hmm. We don't tend to cater to that. The only time we ever look at short-term things, meaning swings that might last a couple of weeks, okay, is when we know that there's a proximity that if you get a short-term swing, let's say downside in the S&P, that if it's only this much, you could trigger something bigger. Mm-hmm. So again, the domino effect. And the S&P and the NASDAQ are set up that way. There's a lot of indicators we've got on them that indicate you don't want to wobble even several percentage points. You don't want to get it started. The bulls have to keep bidding and bidding. Otherwise, this thing, it could come apart because there's so many structures on momentum to break below that are clustered not far below. You don't have to have a 20% correction to get into a bear mode. We'll get into bear mode less than 10% below here, mm-hmm. far less. A big long-term bear market mode, meaning breaking annual momentum structures, things that go back a dozen years, where you look at a price chart, again, you can't see the breakage, but you look at our momentum charts, you say, oh my goodness, there's a bridge on the River Kwai. If you break that, you blow it up, okay? And they're waiting not far below. So yes, you're right. Certain lesser things can topple into bigger things. And that's why we're aware of these technical events.
So how many factors do you need to add up to a signal to enter or exit a position, Michael?
Well, we don't black box necessarily, because each of our subscribers, we've got large asset managers, financial institutions, hedge funds around the world. We've got corporations that are focused on given commodities. We've got a Chinese commodity trading firm, and we've got a large beverage company in Europe and so forth that are focused more on things like, what's orange juice doing? Okay. So we look at various markets for various clients, but when we assess the core markets, the four asset categories: foreign exchange, debt markets, stock markets, commodities. We're generally looking for trends that might last several quarters or several years. So we're not so focused on, what's going to happen the next 2 to 3 weeks, and here's our buy and here's our sell.
Mm-hmm.
There's plenty of market letters that do that with price charts. We don't do that unless we think those smaller time scales are important, in terms of being a domino. So our focus is generally longer term. And we also know that everybody who pays for our research, each of them have different goals. One of them might be to hedge, their production costs. Mm-hmm. The other might be long-term investors who are focused mainly on commodities, some focused on the bond market, et cetera. And so when we provide numbers, it's not like a black box. Okay, here, everybody go buy and everybody go sell when we say sell. It's an ongoing process of analysis. And we do provide specific numbers. We're very number specific. Mm-hmm. And we try to anticipate ahead of time when we see a trend change coming, so that you're not taken, shocked by, sell. Okay. We warn you, okay, this market is looking vulnerable. It's not broken yet, but here's our numbers, and we adjust them month by month. And if you break them, then we say sell. So that's how our process works.
So when we're thinking about using momentum analysis to gain a different perspective on the movements of markets, what are the real advantages of using it versus just looking at price charts?
Well, first off, you got to realize that price is a distorted yardstick. Unlike a thermometer that you put in your mouth to take your temperature, you trust that the thermometer is measuring you, and that the thermometer itself is not changing its gradient every day. Okay, and with a yardstick, you want to know a 36 inches stays 36 inches and doesn't grow 3 inches and still say 36 inches. Okay, so then it's a lying yardstick, a rubber yardstick. Well, money units are garbage. Okay, they double. The U.S. money supply measured by M2 doubles in quantity, almost doubles every decade since 1959. So your yardstick is doubled and still says $1. And you're measuring via that yardstick. So when you look at a price chart, you're measuring via a rubber yardstick. Now that yardstick is far more rapidly increasing in quantity. Okay. So when we measure by momentum, we try to take a step away from the simple fiat currency that most people are using to measure. We measure by means of an average, moving average that is a function, yes, of the price, which means of that fiat money, but also of the dynamics of the movement of that market, because that moving average changes. It accelerates upside or downside depending on the rate of change in the underlying asset. So some bull trends might be sluggish, and therefore the moving average might move up sluggishly. So your yardstick is shifting with the asset. And some markets are dynamic, and therefore that yardstick is increasing with it. So to some extent, the moving average is a metric. It is not just subject to the fiat currency, but subject to the attributes of the underlying market itself. And so we take a half a step away from simply looking at price charts. Mm-hmm. And what we look for is the same thing price guys look for: trends, a very clear trend structure, like 3 points on an uptrend. Each low lines up on the trend line. Aha, you've got a line. Now you can plot it. It's credible. Or a floor that's used over and over, same level on momentum. May not show up on the price chart, but it shows up on momentum. Mm-hmm. And that's what we're looking at in the case of the S&P and the NASDAQ right now in terms of annual momentum. They've got a floor under them we can define with pretty clear precision. And if you break below that floor, they're going down. And that floor is not far below. And it's determined not so much by the change in the fiat currency, but in terms of their own past dynamics. And so by using momentum in the way we do, looking at structural aspects, we think we have a heads up generally in trend changes, which we see them coming ahead of time. And once the momentum breaks, usually price will then follow with its own version of breakage. But it could be a couple months later. Momentum will often lead price by quite a bit of time.
Interesting. So, Michael, in one of your recent reports, you marked it with a red exclamation mark, indicating the most potent momentum structure. So, what defines a potent momentum structure to you?
Well, it's subjective to some extent. It's experience based, but we could probably put one of our momentum charts in front of an average investor who's used to looking at price charts, and put a momentum chart in front of him, and he could see the structure that we're talking about. It doesn't take a scientist to see it. In other words, when a market hits the same level 2-3 times, not in price, like a stock drops to 20, rallies 20, 20, 20, that's a price structure, but on momentum. And the price chart might be going up with no such floor. But when you see momentum establish a very clear structure, you simply plot it. And that's what we do in our reports. And we say, this structure needs to be watched, because if you break it, price is going to follow. And usually it'll usually break well before upside or downside, before price will do the same. And it jumps out at you. It's visibly obvious.
And it almost seems that the longer that channel, let's say, has been established for, the more power that move That's has correct. Once it breaks out.
Well, the phrase, and this applies to price as well. The bigger the base, the bigger the move, the bigger the building. Okay, well, that's the same. The bigger the top, the bigger the drop. Okay, so that applies to momentum structures. The wider it is, the longer term the metric is that you used. In other words, if you're measuring something versus a 3-day average, that's very short term. You might have a nice structure, but it's only worth 2-3 days of trading. Okay, but if you measure something versus a 3-quarter average, or a 3-year average, or 3-month average, then when you break a clear structure, it has more oomph to it, more potency, right, both probably in price terms and in time. And that's what we're looking for.
So when we're thinking about, let's say, proxies for gold and silver by the markets of the miners, the underlying miners like the GDX or the GDXJ, on a day when gold is down and we see the GDX up, can that indicate a sentiment change in that sector too?
It can, and we've seen some of that lately in the last several weeks of upside from the recent lows in GDX. See, gold held its March low. It was 1673. It didn't take it out again. Silver went down and nipped out its prior lows by 50 cents, just enough to run people out, and then shot back up $4. But GDX and the miners went down and took out their March lows. And of course, everybody's pulling their hair out. And admittedly, the miners were underperforming gold since the August high. By the way, they were outperforming gold up to the August high, meaning a better place to have been would have been the miners. Okay. Over the last year or so, they've been underperforming gold. But we measure those situations in spread terms, meaning we plot where, let's say, GDX price is as a percentage expression of the price of gold. So we create a spread chart. And we're looking fairly long term. We're not looking day to day necessarily. And the spreads are starting to shift. And we're not far away from some breakout levels. Now, that would be sort of like a side mirror indicator again. In other words, we're looking at gold and silver for their breakouts. But what we'd also like to see is the shift in the performance measurably, not just day to day, but on a measurable chart where GDX is broken out of a base on a spread basis in relation to gold, saying, okay, I'm back on the winning side now. And we expect to see that. So as we express positive views about gold and silver, if they cross our numbers, highly likely, it's going to be a better place to be in the miners than in silver and gold themselves. And that we measure as well. But there's no question in our mind that you get gold going again and silver going again, you want to be in the miners. But use those two as your guide.
Excellent, Michael. I think that's a great place to wrap up. Is there anything else that you'd like to mention here?
No, I just think pay attention now. I think we're close to some numbers, and I don't think we came back up here to fool around. I think gold came back up here to break through this time. And the structures are very clear. You can see them in our reports. Again, not on the price charts, but on the momentum charts. And silver as well. And it should get exciting on the other side of these structures.
Yeah, it's going to be really interesting to see what happens between now and, let's say, January, and see how this plays out.
Yep,
excellent, Michael. Of course, Your work is available at olivermsa.com and Oliver_MSA on Twitter. Anywhere else you'd like to point to?
No, that's all.
Excellent.
Thank you. We're happy to send out samples to anybody who wants them. Thank you.
Perfect. Thank you so much, Michael.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.